And gentlemen, you have been connected to Marksans Pharma Limited Q4 and FY22 earnings conference call. Please stay connected. This conference will start shortly. Participants, you connected to Marksans Pharma Limited Q4 and FY22 earnings conference call. Please stay connected. This conference will start shortly. Thank you. Ladies and gentlemen, good day and welcome to Marksans Pharma Limited Q4 and FY22 earnings conference call hosted by ICICI Securities Limited. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Rohan John from ICICI Securities Limited. Thank you, and over to you, sir.
Thanks, Shazan. Good evening, everyone, and welcome to Marksans Pharma Limited fourth quarter and FY22 earnings conference call. We have the senior management, Mr. Mark Saldanha, founder, managing director, and CEO, and Mr. Jitendra Sharma, Chief Financial Officer, participating in this call. I thank the management for giving ICICI Securities an opportunity to host this call. Over to you, Jitendra.
Thank you, Rohan, and very good evening to everyone, and thank you for joining us for Q4 FY22 earnings call of Marksans Pharma. On the call today, we will discuss our operational and financial highlights for the quarter and year ended March 31st, 2022. On this call, our discussion will include certain forward-looking statements. These estimates reflect management's current expectations of the future performance of the company. Please note that these estimates involve several risks and uncertainties. We do not undertake any obligation to publicly update any forward-looking statement, whether as a result of new confirmation, future events, or otherwise. Moving on, we have Mr. Mark Saldanha, founder, chairman, and managing director from our management team. To start the call, I will request Mark sir for his comments.
Thank you, Jitendra. Good evening, everyone. Hope you and your families are safe and doing well. It's my pleasure to welcome you to the Q4 FY22 earnings calls. Let me try and keep the remarks short so we have more time to take your questions. FY22 was a challenging year for the industry. We witnessed continuous impact from geopolitical crisis, supply chains, and inflationary headwinds across our key markets. COVID resurgence in China, input cost pressure, and increased freight costs didn't make it any easier. Pricing pressure in U.S. continued in the high single digits during the year, impacting our generic U.S. business. These developments impacted our gross and Ebitda margins. However, despite these challenges, we had a decent revenue growth in the year led by North America and Australian market. We have also started passing our, the price increases to certain of our customers. The development of our Goa factory, which included the addition of a new manufacturing line, is on schedule and expected to start by the end of this calendar year. We expanded our portfolio in this quarter by launching 3 new products in the US and 12 in UK. We are also strengthening our R&D capabilities and have a strong product pipeline in the near term. We plan to launch several new products in the next 2 years. I would like to reaffirm that a forward integrated business model which has a significant global presence is quite unique. Our business model has evolved over the period of time from 100% CRAMS driven to 100% own IP driven forward integrated business. We have emerged as prime manufacturers and marketers in US, UK and Australia. We have established a strong presence in these countries with our front-end distribution capabilities. This is obviously supported by low-cost manufacturing base which we leverage out of India. We are also prime manufacturers of soft gels products from India. We are expanding our manufacturing capabilities and taking new steps to backward integrate into API manufacturing of our core molecules for captive consumption. And our aim is to become fully integrated company with our own API formulation manufacturing and our own forward integrated marketing into the biggest markets in the world. With this, I would like to turn it over to Jitendra, our CFO, who will give you an update on the financial before we can take your Q&A. Thank you.
Thank you, sir. Let me start with the financial highlights for Q4 followed by FY22. Operating revenue was at 418 crores, increase of 26.6% compared with rupees 330 crores last year. Gross profit was at rupees 206 crores in Q4 of FY22, increasing by 1.5% year-on-year. Gross margin stood at 49.4% in Q4 of FY22. Ebitda was rupees 63.6 crores. Ebitda decline was due to continued input cost headwinds and elevated freight and packaging material costs. Our depreciation increased on Ind AS 116 lease accounting. We have taken few large warehouses in USA and UK on lease and have created a lease liability and right of use of assets, providing for additional depreciation of rupees 12 crores in Q4 of FY22, with a total depreciation charge of rupees 21 crore in the Q4. Our profit before tax was at 52.6 crore. The profit after tax was 29.7 crore for the quarter. There was a consolidated tax provision. The consolidated tax provision included a deferred tax provision of rupees 7.8 crores on account of capital leases, property and equipment. Summarizing our FY22 results, our revenue was at rupees 1,490 crores, representing a growth of 8.3% as compared to FY21. From a geography perspective, US North America was the highest contributor at rupees 635 crores, witnessing 8.5% growth from the year FY21. EU and UK formulation market recorded 4.7% growth at rupees 609 crores. Australia, New Zealand formulation market recorded 22.9% growth at rupees 179.8 crores, whereas the rest of world recorded 7.3% increase in the sales to rupees 66.9 crores in FY22. The gross profit was at rupees 774 crores in FY22 compared to rupees 781 crore last year. Ebitda was at rupees 258.9 crores as compared to rupees 339 crores in FY21. Ebitda margin was at 17.4% in FY22 as against 24.7% in FY22. PAT stood at 186.8 crores in FY22. The EPS for the year stood at rupees 4.51. We continue to invest in capacity expansion with our capex being at rupees 46.3 crore in FY22. Our R&D spend in the year was rupees 30.2 crores, that is around 2% of the sales, and we expect R&D spend to increase to 4 to 5% of sales over the next few years. We launched 12 new products in UK region and 3 new products in US. Our pipeline for next few years remains healthy, with more than 76 products, out of which 34 products are in UK, 32 in US, and 10 are in Australia and New Zealand. In the UK, out of the 34 products in pipeline, 8 of them are planned to file in FY23. In addition to these products, 16 products are already filed and awaiting approval in UK markets. Talking about the US region, out of the 32 products in pipeline, 27 are in OTC and 5 are in RX. We continue to remain debt-free, and our cash and cash equivalent in the books was at rupees 349.3 crores. We have seen continued increase in input cost pressure during the last year. Given the current uncertain macro outlook, we remain a bit cautious. However, we are positive about the business prospects over the medium to long term. With that, I would like to now open the floor to question and answer. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. A reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time. First question is from the line of Vijay Nahar, individual investor. Please go ahead.
Congratulations on the figures, trying to manage the figure in spite of the several
Sorry
challenges.
to interrupt you, Mr. Nahar. The audio is not clear from your line. Please use the handset mode.
Yeah. Congratulations for the figures in spite of a lot of challenges. But what I like to know is what were the challenges which affected the cost, and which of these cost increase have been passed on to the consumers, such as logistics, the raw material price increase, and the effect of the China lockdown.
Yeah, hi. This is Mark Saldana. So the challenges, like we've explained, are multifold. One is obviously the China lockdown, which has a cascading impact on all input cost of raw materials, excipients, chemicals that go into manufacturing of products. With the war in Ukraine and all these embargoes happening on Russia, obviously the oil prices are not getting any cheaper. So this has basically had an impact on freight cost, which has gone up tremendously. And obviously any items which are derived from more from oil derivatives have also increased. A lot of our packaging cost has increased. So overall input cost onto a product has gone up. We are working into basically passing on whatever cost we can with the price increase to our customers. But that said and done, while last year was more of a pandemic status quo, today, this year, the world is just coming out of a pandemic. So there has been a correction in distribution channels in certain markets, in our key markets. And this basically, when there's a change in the distribution channel and inventory deflation is happening, pricing pressure is also there from, because there's more of supply and less of demand. Definitely there is pricing pressure that one has to take into account. But that said, 2022 has been a challenging year for different reasons than 2021. But all said and done, we have kept our market share. We are growing in terms of sales and in terms of revenue. There has been pricing pressure on the bottom line, but we are still holding strong in certain other areas.
Thank you.
Thank you. The next question is from the line of Rajiv Rupani, individual investor. Please go ahead.
Yeah, hi. My question was on the warrants issued to Orbimed and to you, Mr. Mark. So the amount to be raised was 90 crores, and it was on 20 July 21. So almost a year has passed. So when do you propose to pay the full amount and convert the warrants into shares?
So the warrant, at the time of warrant issuance, the 25% money we have received upfront. Now warrant is convertible anytime, in next 18 months time. So in terms of the fund requirements, we have completed one acquisition in Dubai. We are looking at few more opportunities, and we do have a capex plan also. So exactly in terms of the timelines, we are looking at somewhere in this year the conversion will happen and the balance money will come in.
So even if the share price is below the conversion rate, the warrants will be converted into shares. Am I correct? Am I reading this correct?
Yes, that is correct.
Okay. My next question is, you had guided for 2,000 crore revenue target in the next few years. So how much time? Is it 1 year, 2 years, 3 years, 4 years, 5 years? By when do you reach the target?
So we had always projected that within the next 3 years we will touch. We are on path of touching 2,000 crores, and we are pretty much on target.
Okay. And the next question is, earlier you had guided for Ebitda margins of 23 to 25%, and this in Q4 our Ebitda margin was 15%. So going forward in the next year, due to the challenges, will our Ebitda margin be 15-17% only?
See, for the current year, looking at the existing scenario, definitely the margins are under pressure. The input costs have not started coming down as yet, though they have stabilized a bit, but still they are on a higher side. Similarly, on freight costs also, we are not seeing any immediate reduction. So we believe that this year the Ebitda margin pressure will continue, and we are expecting the Ebitda in the range of 17 to 20%. The FY22 overall Ebitda was 17.4%, and we expect the Ebitda to remain between 17 to 20% in this year.
Okay. And my next question is, you plan to incur a capex of 200 crores, and capex already incurred is 46 crores. So, and you talked about backward integration and manufacturing our own APIs. So the current capex of 46 crores, is it for APIs, and the balance amount will be for our own APIs? And then by when do you propose to do this?
See, the 46 crore capex was mainly into formulation manufacturing facilities across the company. So we have 3 plants, one in India, one in UK, and in US. The API capex basically is planned, and the 200 crore capex plan basically will have both formulation as well as API capabilities. And it will basically, we are in the process of, identifying various targets, basically, so far as the formulation manufacturing capacities are concerned. So we are looking at acquisition, and this money will go towards that, mainly towards that.
Okay. And last question, will be debt free going forward for the next 2, 3, 4 years?
We are not averse to debt. We are debt free as of now. I think with the kind of overall cash generation and cash in the books, there is no need for immediate debt. So unless and until
Sorry, Jitendra, you are not audible.
Sorry. Yeah, just a minute. Is it okay now?
Yes.
Hello?
Yes.
Yeah.
So we don't plan to raise debt in the short term, but in longer term we may have some debt in the book. But again, we basically don't plan to go say beyond 1 EBITDA at any given point of time. But there are no short term plans for raising debt.
Thank you. I'll get back in the queue.
Thank you. The next question is from the line of Piyush Oswal from Piyush Oswal and Associates. Please go ahead.
Yeah, congratulations on the wonderful performance. I just wanted clarification on the trade receivables are constantly increasing. Any specific reasons for that?
So the receivables have increased during the year, basically, which is in line with the increase in the sales. And we have also, in certain geographies, few customers, we have increased the credit period due to the current the market situation out there. But the overall average receivable levels are, around 90 days, which are in line with the overall industry standards. And we are regularly monitoring the levels. We don't see this to further increase.
Okay. Thank you so much.
Thank you.
Thank you. A reminder to the participants, anyone who wishes to ask a question may press star and 1. The next question is from the line of Manoj Matthew Jacob, individual investor. Please go ahead.
Hi, congratulations to the team. My first question is, recently in paper, it appeared that Marksans had acquired some land in Madhya Pradesh for setting up a factory. Is that true? And second, what about the API? Because after the 2020 results, I remember Mark saying that we'll be setting up the API within 2 years at the max, or within 18 months. So if you look from 2020 March, it's now almost 2 years.
Yeah. Just to answer your first question of Madhya Pradesh, yes, we have applied for allocation of land out there in Madhya Pradesh, so that's true. That's again a greenfield project that we are exploring. With regards to API, we have started working on R&D and our own DMFs in terms of multiple products. Nearly 6 or 7 of them are actually working. Our aim was to do an inorganic strategy in API, but identifying companies and just working on valuations of those targeted companies was taking a bit longer. 2020, obviously, API companies had crazy valuations, so consummating or finding the right partner was a bit difficult. Now that reality has seeped into 2021 and 22, we are still exploring that. Nothing concrete has come onto that, but at the same time, we are working on organic strategies, and our R&D is near completed on quite a few products, and we are hopeful that hopefully by the end of 2022 we may have few DMS filed with our own API.
With your own API, so it will be organic.
Right now it's organic, but inorganic, if anything comes through, then everyone will be the first to know.
Okay. And second, the last question, may I ask you? You have taken additional lease capacity in US and UK. That means you plan to stock more over there.
Yes, these are the warehouses which we are using to keep our stocks.
No, apart from existing warehouses, you plan to stock more by taking new warehouses. Am I right?
Yes. Yes, that is because of increased demand and the inventory cycles servicing customers.
Okay.
And again, the waves, in terms of COVID, it comes, goes. So we're just trying to preempt and ensure we have enough of stock. The logistic timelines have gone crazy earlier. Shipments from India to US were 21 days. Today it's about 60 days. So this has prompted us to have better inventory out there to avoid any stock out positions.
Okay. Thank you very much.
Welcome.
Thank you. Participants, to ask a question, you may press star and 1. The next question is from the line of Shakir Rao, individual investor. Please go ahead.
I have 2 questions. One is the Access Healthcare that you are in the process of acquiring. If you can slightly elaborate on what is the plan with that organization. The second one is APIs you are planning for core molecules. How many you consider as core molecules based on the current business? These are the two questions.
So the acquisition in Dubai, basically, it's a virtual company, marketing, solid oil, formulations basically in UAE. We are looking at Dubai as a port of entry into Middle East. So we have few geographies that we will be expanding from this base and moving on. Again, this is a very niche territory, but we do see a lot of value addition coming there into such arenas wherever there is niche. Dubai basically for us is a platform for distribution in the Middle East.
Okay, thank you.
Thank you. The next question is from the line of Manoj Matthew Jacob, an individual investor. Please go ahead.
Mark, I remember one more thing you had said, that in 2023 or 2024, Marksan will have a unique product which is maybe second in India to the world, to international markets.
Could you repeat that? Unique product or product?
Yes, a unique product for either US or UK market, which will be the second company in India to offer that.
So I won't recap that statement per se, but
it might be the loratadine soft gels. We have a couple of products wherein we are
we have a couple of products where we are first to file, uniquely positioned in terms of being the only generic item in the US. But these are pretty niche molecules, but it gives us a space and identity to be created. We are working on one more molecule, which again, hopefully in 2024. Should see the light, but again, we are basically into a generic phase. We don't do our own NDA, so we are into a generic space, but we try to basically identify molecules where we could have that early launch and early time scales from that angle. But again, we are not into drug discovery or basic research to come up with anything which is patented as on today.
Okay. Thank you.
Thank you. The next question is from the line of Yogesh from Arihant Capital Markets. Please go ahead.
Thank you, sir, for taking my question. My first question is on depreciation. If I would have missed it in the earlier call. So it's like it has depreciation and amortization has increased by about more than 100%, like 21 crores for the quarter. So just wanted to understand that, and would this be the run rate going forward quarterly?
Yeah, hi Yogesh, this is Jitendra here. So, no, as I mentioned in my opening remark, actually, we have adopted Ind AS 116, while consolidating the US and UK balance sheets into the Indian parent company balance sheet. So we have taken warehouses in these geographies, wherein we have provided for lease liability and a corresponding right of use assets. So in Q4, we basically provided for the depreciation for the whole year on these assets. So basically, there is an increase of 12 crore rupees in depreciation figure. Now, in the current year, it will basically come as a quarterly charge of 3 crore every year. So definitely the depreciation will increase, but not to this extent.
Thanks. And the other one is on the finance. So that is also increased on a quarterly basis, like from 1 crore to approximately 5 crores. So what would be driving that number?
Pardon me, which cost?
The finance cost. The finance cost is about 5 crores for Q4 versus 1 crore in Q3. So and it was even like 3 crores in last year, Q4 FY21. So the increase in finance cost, what would be driving that?
See, the finance cost basically includes, we have a working capital, facility, though we don't use it. But then we keep paying, say the processing charges. We open a lot of LCs, so LC opening charges we pay to the banks. Since we are not utilizing the limits, we have to pay some commitment charges to the banks also. So basically, the finance cost includes all these bank charges. And we also have a preference shares of 5 crore where we pay dividend. That dividend amount gets into the finance charges.
Sure. And one on the inventory days. So for FY22, there has been a jump in inventory days of more about 95 days something. It was around 80 days earlier. So any factors driving that jump in the inventory days for FY22?
So
not the inventory, debtor days basically. So there's a jump in the debtor days.
Yeah, debtor day has gone up. As I told earlier, basically it is mainly on account of increase in sales and also on account of increase in credit period to few customers in US and in UK.
And
but
what
we don't expect it to go further, and I think it will remain, around 90 days in coming quarters.
Sure. And what would be the percentage price erosion in Q4 for the US business, approximately?
See, the overall price erosion for the year we can say is in single high digit number.
Okay. And one on, so it's like you mentioned about the conflict in Ukraine, Russia driving the, commodity and the prices. But will that effect mainly come in Q1 because the crude oil actually started going up in late March and it's persisted. So will the major impact come in Q1 FY23 on raw material?
No, impact is already there. See, there is no further increase as such. The input cost and freight costs are increased throughout the last year. Throughout FY22, the cost was on a higher side only. And I think in the current year, we are seeing the similar prices. We are not seeing any further increase. But then the prices which has gone up have not started coming down as yet. So we see the existing prices to stabilize and they will remain on a higher side, but we don't expect further increase in these prices.
So the gross profit margin would be in the 50% range. It was like 53% in Q3 and now come down around the 49.5%. So would be in that range for the first half of 23 in around 50%?
Yeah, see, we are expecting the gross margin in FY23, in the range of 50 to 52%, between 50 to 52%.
50 to 52. Yeah. And lastly, one on the effective tax rate. So there has been a jump from 20 to 43%. So what would be that component, the increase in the effective tax rate?
See, the effective tax rate on consolidated accounts was around 24.5% in FY22. And there was an increase because of provision of deferred taxation on account of capital leases. And that amount was around 7.8 crore rupees. So in the current year, we see the effective tax rate to remain in the range of 22 to 24%.
Okay, 20 to 24. And lastly, on the product, one more on the cost raw material front. So we understand that paracetamol related products are your major cost. So there were news that there were some Chinese manufacturers who have restarted paracetamol related products. So will that affect the prices? Will it lower the prices for this raw material?
Yes,
we are hoping for the best. But even for it to have any corrections, at least for the first 6 months, we don't foresee any difference. And we and as a formulator, we need to keep inventory. So we already have a lot of raw material in transit or in stock with us, which will last us for another 5 to 6 months. So effectively, We don't see the prices correcting within the next 6 months, but we are hoping for the best.
Sure. And lastly, on the product launches, so as we know that there has been this pricing pressure in the US, so one of the strategy would be to launch products. So if I take around high single digit of 9% price erosion in FY23, so what would be the target product launches in US which can offset this price erosion so that the US market can grow in FY23 for a company?
Well, there are multiple things that look at the challenges to overcome price erosion. But US approval first has to come with obviously FDA approving your product. That becomes the first benchmark to get your product into the US market. And once it's approved, then we can talk about the launch. And again, then after that, getting market share into a market which is consolidating due to the distribution channel deflating. So challenges are there, but we are optimistic. We have over a period of time, gained that market identity and reliability in terms of prime manufacturer and marketer and of products in the US. So we work pretty much on a daily basis, on a monthly basis to penetrate the market and to get market share. And hopefully once the product gets approved by FDA, we do aggressively try to get a market share of that particular molecule that gets approved. So as and when newer products come in, we definitely see a growth in terms of revenue happening. The bottom line pressure is a different issue. The bottom line pressure is always going to be based on input cost. But definitely the sales pressure, the sales point of view, we do see a growth happening year on year and moving forward.
So Yogesh, we are expecting 3 to 4 new launches in US in this year.
Thank you very much for taking my questions. Thank you.
Thank you. Reminder to the participants, anyone who wishes to ask a question may press star and 1. The next question is from the line of Venkatesh Sethuraman from Windhorse Capital. Please go ahead.
Good evening, team. I have 2 questions. One, given how strong OrbiMed as an investor is in the healthcare space, has having them as an investor in Marksans helped you in any way in either understanding the markets or looking at opportunities for both organic as well as inorganic? And what sort of expertise they have provided to help you? That's one question. The second is, without getting into specifics, without divulging anything that's non-public, would you be able to give us an idea of what the KPIs were when they came in as an investor, where you have gone off track, and what sort of corrective action you are taking to get back on track?
Yeah, sorry, I didn't get a second question. Could you repeat the second question?
Yeah, the second question is, when you were soliciting investment from OrbiMed, you would have made a pitch to them and you would have given them, some kind of an understanding of where the business is going, and on the basis of which they would have made the investment decision. Now, where have you gone right? Where have you gone wrong? Or where are you off track to what you promised them? And if you're off track, then what corrective actions you're taking? And if you're on the right track, then what are the things that are going right for you? And as I mentioned, I'm not looking for anything that's not public.
Okay. So with regards to OrbiMed, we have very good meetings with them periodically, monthly, quarterly, And I do believe their understanding of this space of pharmaceutical is great. They had a tremendous value in terms of identifying targets and very fruitful discussions on their expertise and experience that they've been in as investors in this industry. They are working closely with us in identifying potential targets, but it takes time in terms of going through the entire process. So I do see a lot of value addition, both tangible and intangible, being done by OrbiMed. So they are a fantastic investor from that point of view. Just to answer your second question, we are pretty much on track on whatever we have committed publicly. I've always mentioned a 2,000 crore target, and we are pretty much hitting that objectives. The only difference, that if I could put any difference, is obviously the bottom line expectation, and that is something like a force measure where you have COVID, you have war happening, you have certain things which are beyond your control, and this is more of a global phenomenon than a company-specific phenomenon. And in terms of out-of-box thinking, corrective actions, whatever we can do within our purview, we are working on it. But whatever we have publicly mentioned in terms of both organic and inorganic strategies, we are pursuing it, and we are seeing some traction, some advancement out there. But all these take some time to actually come into play. But we are quite happy with the progress, and I'm sure they should be happy. I can't speak for them, but they have a visibility on quarter to quarter. They have a board member on the company, so they are quite interactive, and they are quite involved into what we do. So I'm sure they're happy with what they see.
Fantastic. Thank you so much, Mark. Thanks for that.
Thank you. Participants, to ask a question, you may press star and 1. The next question is from the line of Rajiv Rupani, an individual investor. Please go ahead.
Yeah, thanks for the opportunity again. The company that we acquired in Dubai, so what was the acquisition cost, one, and how much will it add to our top line in let's say, in the next 3 to 4 years?
We have acquired this company for a cash consideration of 13 million AED. In terms of rupee, it will come to somewhere around 27-28 crore rupees. The existing revenue of the company is around 14 million dirhams. So we have acquired them at almost around one-time sales. In terms of where it can go in next 3 to 4 years, of course, we are very excited with the prospects of this company, this business coming into Marksans' fold. We do see a lot of potential of growth here, and we are very confident that we will see, we will take this company to, double the revenue over, say, next 2 years' time, once we take over the charge of the company.
Okay, and again, a question on the warrants. So, why don't you, Mark and OrbiMed, convert warrants into shares now? Because only 6 months are left, irrespective you do acquisition or not, or the acquisition is delayed or by some time.
Again, this warrants has obviously we have a gestation period of 18 months from the date of when it was applied. As on today, the company does not need the funds presently. We already are sitting on a war chest which we are using for acquisitions. And we do believe within the period of that 18 months, because obviously we don't want to request for funds too early, it may not be fair even to OrbiMed. But as and when it's closer to the due date, the funds would be put, the subscription would be completed. And in case there's an acquisition that happens and we need to ensure that we have to get the funds earlier, then we would obviously make a request, the company make a request to convert it earlier, and it would probably happen at that time.
And my last
based on the company's need for cash to call for the funds.
Thanks. And my last question: don't you think the dividend declared is too poor?
In today's challenging scenarios, we are slowly working on improvement. This is a trend that we would like to eventually keep increasing. We are quite optimistic in the future. But today's scenario, I think it is based on various other calculations that are taken into consideration that we arrived at that dividend.
Thank you.
Thank you. Participants, to ask a question, you may press star and 1. As there are no further questions from the participants, I would now like to hand the conference over to the management for closing comments.
Thank you everyone for taking your time off and getting onto our call. The management is always committed, as always, and I hope we've met with your expectation. And please be safe and be well. Thank you very much.
Thank you. Ladies and gentlemen, on behalf of ICICI Securities, that concludes this conference call. Thank you for joining us, and you may now disconnect your lines.